Okay, we are with Lyn Alden. And Lyn, thank you for doing this. Your book is like a beast. And I mean that in a positive way. Like, this is just, I have so many like dog ears on these pages of this book that I had to start using the bottom of the book. And so then it became rather useless, Lyn, because I was dog earing so many pages. I thought, oh, well, I guess I just have to read the book like multiple times. So thank you for the book. I mean, I can only imagine how much time you put into this and how serious you take things. It shows. So thank you. I mean, that's definitely a book I'll be handing out and recommending to people. So really, thank you for everything you've done with that. Really appreciate it.
I appreciate that. Thank you.
And I have questions for you on the book, but I want to jump in on your latest premium report. You had some stuff that I was just reading about, and I just want to get your current thoughts on it. So hopefully I throw you some curveballs that gets Lyn Alden thinking, maybe she hadn't thought about something. And I highly doubt that, Lyn. Knowing you've analyzed everything and 10 times over. So here we go. In the report, you were talking about the Treasury and kind of a surprise announcement that the percentage of debt issuance that they recently had was Treasury bills and not like longer term debt. So why was that a surprise to, people like myself who are reading that who maybe don't quite fully understand? Why was that a surprise? And why is that a sign of fiscal dominance? Can we start there?
Yeah, sure. So in general, the Treasury tries to maintain a pretty kind of static ratio between T-bill issuance and longer duration bond issuance. And the problem now is that they're releasing more into the market than normal. The deficits are unusually large, especially outside of a recession or other kind of crisis event. And so there's just kind of like this ongoing quarter by quarter deluge of supply. And the Fed's also doing quantitative tightening. So they are, they're selling through maturity. They're letting bonds mature off their balance sheet and not reinvesting those proceeds, which is effectively a sale. Because the dollar index is strong, there's not a lot of foreign demand at the moment. That's unintuitive to people, but basically when the dollar is strong, usually the foreign sector is not really buying a lot of treasuries. They're often more in currency defense mode. And if anything, they're either selling reserve assets or they're more often just holding flat. Whereas when the dollar's weaker, they're more likely to be in reserve accumulation mode. And so they're not really on average buying at the current time. And then also banks are, kind of carefully managing their duration. And for the first time in a long time, they had an absolute drop in the number of treasuries they were holding. And so with all of these buyers off the table and how much supply is coming, that means basically all of it has to be absorbed by the domestic non-bank sector. So insurance companies, pensions, asset managers, households, hedge funds, and these are entities that generally don't have all this extra leverage. For example, the banking system has leverage, the Fed has leverage, but these are less flexible balance sheets to absorb all of this. And one of the remaining pools of capital, pools of liquidity available, is the reverse repo facility. That you can kind of consider that like a spillover for like excess demand for T-bills specifically, not for longer duration, just kind of T-bills, like cash equivalents with no counterparty risk. I mean, your counterparty is the Fed. And so money markets could easily replace some of their reverse repo exposure with more T-bill exposure. So right now, there's at least $1 trillion worth of T-bill exposure that could rapidly be consumed by the market. Which is not always the case, but that's the case right now. Whereas there's clearly a more limited demand for longer duration, like T-notes, T-bonds. And so rather than just the Treasury kind of keeping with their normal cadence and their normal split of how they're doing things, they've been very aggressive on the T-bill side, which is interesting for a couple of reasons. One, it's the more expensive part of the curve. So the Treasury has to optimize for a couple things. One of them is trying to minimize expense for the government. And yet we have an inverted yield curve and they're still issuing on excess amounts on the short end. But number two, they're also doing that to not hurt liquidity. They don't want to draw, value out of bank reserves. They'd rather kind of pull from this reverse repo facility. And so basically it was like a bigger than normal jump for what the Treasury would do. I think it's one of those things like it's just not something that most people follow. The quarterly refunding of treasuries is usually a boring thing. But this was probably the first time where a Treasury refunding announcement probably moved markets more than an FOMC announcement from the Fed, just because there was kind of more of interest there. And in some ways, the Treasury has been affecting liquidity conditions as much or more than the Fed lately. And so these two forces have been kind of at odds. And so it's interesting that there's another variable there that can, surprise us one way or another quarter by quarter.
So then what happens when the reverse repo facility, is this reverse repo facility something that's always existed? Or is this like a new thing since quantitative easing? And what happens when the reverse repo facility drains out? Because I think it was earlier this year, it was at like 2 trillion. I think it's like 1 trillion now. So at that pace, we're like within the next year, it looks like it drains right out. So is it something that's always existed in the current financial system? And what happens when it, in your opinion, when it just drains out?
So in this modern era of balance sheet management, so kind of post GFC, it's been more of a phenomenon. And basically, when there's been a period of excess QE, that's when it's almost like you've filled as much water as can fit in the bucket for the time being. And so that money just starts having to spill somewhere. And so they open the reverse repo facility, it spills into there. And then when they stop doing QE for a while, it eventually starts draining back out of that and back into the broader market. And so we did see a little bit of usage of it in the prior rounds of QE, QE like 1, 2, and 3. Now, what happens when it runs out? The most destructive period for that is probably the 2019 repo spike. So that was the opposite problem. Right now, there's excess demand for T-bills. Basically, the reverse repo facility represents roughly an extra $1 trillion worth of demand for T-bills that money markets, would happily buy and just take it out of the reverse repo facility. Back in the 2019 period, there was a similar environment of kind of surprisingly big deficits for a non-recession. I mean, nothing like now, but basically deficits were widening at a time when we were not in a recession yet. And the Fed was doing quantitative tightening like they are now. And out of nowhere, repo rates just blew out. So basically, rates that financiers deal with each other overnight just went like 7%, like out of nowhere. And so the Fed basically jumped in with emergency repo activity, not reverse repo, but repo. Because at that point, the reverse repo was drained. And there was this ongoing need to finance the deficits. And you also had a pretty strong dollar environment. So there was not a lot of foreign buying of Treasury. So kind of all the same setup happened, and it manifested in the reverse repo market getting messy. And the problem there is if that had persisted, it would have spilled over into the Treasury market because at that time, especially the remaining buyer was hedge funds. And they were using repo to finance their Treasury purchases, and so obviously you can't finance at 7% and then buy whatever the T-bill was yielding back then, which was quite low. So they came in, they stopped doing reverse repo. There are some of us analyzing it at the time, like myself, Luke Groman, a handful of analysts, because a lot of people were trying to figure out what was happening. Whereas our argument was that this was basically a T-bill oversupply problem, and that the Fed would, even though it seems like a repo problem, is actually a problem of just too many T-bills relative to other liquidity. And so that the Fed is probably going to come in and have to start QE again. And within weeks, that's what they did. By, the repo spike happened in September. By October, they started doing QE. And they didn't want to call it QE because they were only buying T-bills. They weren't buying longer duration. And they were not doing it for the intent purpose of stimulating the economy. It was just kind of managing liquidity. They were just going back up to a gradually expanding balance sheet again. So I think we could run into a situation like that where you kind of hit zero and maybe you stay at zero for a while as the Fed keeps draining. But then some weird dislocation happens. Maybe Treasuries shoot up 100 basis points one day. Maybe repo rates get weird one day. And then it just kind of, most, unlike a bigger crisis, this was one that only really market participants or like financial plumbing analysts were looking at. The average person street was like, what are you talking about repo? Like it doesn't matter. So this was one of those like crises. And I think basically what happens when the reverse repo ends is you probably get a similar event where one day the Fed just has to be like, oh, well, we're not going to reduce the balance sheet anymore. And we're going to go back up to a period of slow balance sheet management.
So it kind of makes me think then, I guess you also discussed this, with deficits at like whatever they're at, 7% of GDP right now. So next year, if rates don't change and next year there is some kind of slowdown, officially a recession in the US or, is called or not, but there is some economic slowdown, tax receipts are down, there's a potential next year in 2024 for a combination of the reverse repo facility being drained out and deficits just going up because there's a recession, there's some stimulus required, and deficits would, like, if they're at 7% now and a typical recession, might move them 6 percentage points, it could go to like double digit deficits. I'm hesitating to even say it, but double digit deficits, and a situation where there's a reverse repo causing like some disjointment in that market. 2024 seems set up for it's going to be necessary for some brand new liquidity to come into the market. It almost seems like a certainty. Am I being kind of too naive thinking that way?
Well, so I try to never use the phrase certainty, but I do think that 2024 is probably going to see the end of balance sheet reduction. The reverse repo facility is one of the metrics that I'm watching pretty closely for that reason. Once we start getting down to a few hundred billion, that'll be kind of all eyes on the reverse repo facility. And I think so. The normal in recent recessions, these have been pretty big recessions. Obviously, COVID was a giant kind of weird recession. The 2008 recession was very big. The 2001 recession was smaller, even though it didn't seem like that for U.S. equities, but it was a smaller recession by most metrics. The 6% increase that people often cite, I would probably expect it to be a little bit smaller this time because I wouldn't necessarily expect a 2008 style recession. I think they're probably going to be tighter with stimulus this time around. And unlike in the prior couple recessions, there's actually a pretty meaningful interest rate reduction that can happen if the Fed decides to cut rates in the face of that. So while you would have weaker tax receipts, and you might have some stimulus, you'd also have likely a reduction in interest expense by the federal government. And so you probably would have several $100 billion of deficit reduction, but then you also have several $100 billion of increase in deficit. So, but the shocking thing is that even at 7% debt to GDP, if you only have a 3% total deficit increase, you're at 10%. And not really, I think what makes this different is that there's really no end to it. It's not like, this is 7% temporarily, and then it's, it's the structure, the overall demographic structure is just inherently deficit bigger now. And not having a structural decline in interest rates, like even if you just go back to a kind of a band between 1% and 6% interest rates. Let's say we don't just keep going up, but let's just we go in a band now. That's just a bigger interest expense world. And so I do think that 2024 is probably going to see changes to the Fed's balance sheet management. And I do think that, while I would hesitate to guess the size of these deficits, I think they are going to be very persistent and basically just quarter after quarter, just absolutely massive deficits. And that's going to have increasing effects in the economy.
When you say it so factually like that, it just sounds so simple to me. When I say it, I feel like I'm freaking out, but you say it like, yeah, we're going to have absolutely large deficits going forward. It just seems like a nice factual statement. And I'm thinking, holy shit, what's coming down the pipe? But okay. So then is this one signal for you then also that rates may start to come down? The unemployment rate in the US went up to 3.9%. And I think I can't remember if it was from you or where I read this, that every time there's been about a half a point move in unemployment up from that cycle bottom, typically the Fed starts to cut rates or ease. And I think the bottom for unemployment was 3.4% or so. And I think you were referencing that. So now that it's at 3.9, is that just a signpost for you that it looks like maybe rates might be coming down shortly? Is that still something that you look at as a valid kind of indicator?
Yeah, so the way I phrased it was that historically, if you get a 50 basis point rise in unemployment, it normally leads to a recession. It doesn't just stop there. You don't just kind of go back up 50 basis points and then kind of normalize flat. Usually unemployment keeps going up. And that's, by all accounts, a recession. And so, of course, in a recession, normally you do get Fed easing. Now, it doesn't necessarily happen right away. It's not like as soon as you cross 50 basis points, you're in a recession right away. The Fed's cutting right away. But it's just historically that move has not happened without that over the coming quarters continuing into a recession. Now, I was hesitant to say at this time that some of those rules like that are potentially a little looser in this environment because, we've never had a kind of this divergence between fiscal policy and monetary policy before. We've never kind of had such a big shock to the economy as COVID. And we never had this much so many people just left the labor force permanently after that. And so we have tighter labor force than normal. So, if there's any environment where some of these rules would be broken, like
Yeah, got it.
yield
Yeah.
curve inversion, but it's, I'm not saying that they're going to be broken, but I'm kind of like, I'm observing things and saying this is normally not good, but, um, we'll see what happens. I think,
Yeah.
I think that we've likely seen the top in interest rates. I think that they, if you do start to get softer economy, they could pull them down. But I've been trying to analyze this differently. So everyone's kind of thinking very Boolean, like recession or no recession. Whereas in many ways, this looks more like an emerging market environment. And in emerging market recessions, normally nominal numbers are still shockingly big, whereas real numbers could be struggling. And
Mhm.
you get bigger than normal divergence between sectors. Like if you're an exporter in Turkey, you're probably doing okay because your expenses are domestic currency and you're earning foreign hard currency in many cases. And whereas a Turkish bank could be absolutely struggling, right? So it's like in inflationary environments, in emerging market recessions, you can get bigger divergences between sectors. And one way to think of it is just with an unusually large divergence between fiscal policy and monetary policy, it would not be surprising for in the US or certain other developed countries to have bigger than normal divergences between sectors. Like if you're in an interest rate sensitive sector, that could look more outright recessionary by many metrics. Like U.S.
Mhm.
commercial real estate's already in a recession. Banks are kind of in a recession. Unprofitable tech's kind of in a recession. Venture capital's kind of in a recession. Whereas like restaurants are not in a recession. Travel's not in a recession. Like plumbers are not in a recession. It's just very kind of like it's sector by sector specific, and that's makes sense in an environment where there's such divergence.
And then do you think this current decade is still similar? I think you've referenced it several times that it's similar to maybe perhaps the 1940s, where inflation kind of, rips higher, comes down to a relatively low amount for some brief amount of time, rips higher again, comes down. And at the end of the decade, you've just had this choppy inflation. Whereas in the 2010s, we just kind of had this like steady run. Whereas in this decade, it's just more wild up and down. Do you still feel the 1940s is a similar comparison to what we might be going through right now?
Yeah, I think so. And it's partially that reason, but it's partially other reasons. So, the 40s and the 70s are often used for inflation comparisons. Most people think of the 70s. And both of them had those waves. They both had like three waves of inflation. So that wasn't unique to the 40s. But the part that I emphasized the most in the 40s is that it was fiscal driven inflation. So in the 70s, although there was some component of it was fiscal, there was in the late 60s, you had the Guns and Butter program. You had, basically Great Society and war in Vietnam. These were adding to the deficit. But if you look at the amount of money that was created from bank loans, it was bigger than the fiscal deficits. Basically, the baby boomers were entering their home formation years. They were starting being born in the late 40s, and so by the time they entered the 70s, basically they're in household formation, and so you had a big uptick in bank lending, credit formation, and that was all else being equal inflationary, especially then when you add in constraints like oil crises and things like that. So combination of excess lending, credit formation with real world constraints. The 40s were different in the sense that it wasn't because of excessive bank lending. It was because of just very large fiscal deficits that at some points were monetized and some points were not. But basically, a lot of the new money creation was from these very large fiscal deficits. And so ever since we've kind of entered the 2020s, we've been in that similar type of environment where most of the money creation we've seen is not because banks are lending to an excessive degree. It's been very normal. Instead, it's mostly been very large monetized fiscal deficits. And the first wave of that was stimulus. And now the second wave of it is interest expense. And that's also a similarity that the 40s had was public debt to GDP was very high. It was well over 100%. Whereas in the 70s, the public debt levels were very low. You got down to like, say, 30% debt to GDP in the United States. And so the challenge is that as you get higher and higher public debt, interest rates become a less effective tool for slowing down the economy because, if you have low debt and a lot of bank lending, and you raise rates a lot, you slow down bank lending more than you blow out your deficit. A little bit of both happens,
Mm-hmm.
but the lever is bigger on the reduction of private credit. Whereas if you have like average or sluggish bank lending and you have very large public debts and you dramatically raise interest rates, you do, slow down bank lending, which wasn't that significant to begin with. But then you also are now pouring out very large deficits into the economy, and someone's on the receiving side of those deficits. And while they might not have a velocity of stimulus checks, they have a non-zero propensity to spend. Some of that money is just, if you give a billionaire more money, they're probably not going to go spend it. But if you give a lot of upper middle class retirees more interest expense from their money markets, and they've got a locked in fixed rate mortgage, higher interest rates basically stimulate them. It gives them more spending power. And it's one example of many. But basically, when you look at all this interest expense from the US federal government, there are entities on the receiving side of that, and some of them do spend.
Just wonder where this then goes with like M2, because it seems like I've kind of recently just been sharing with people that, hey, you have to outpace M2 growth, whether it's in Canada or the US, whatever M2 is going on with M2 and whatever the growth rate of that is. And I know you referenced this kind of concept in your book as well, in some great detail, that you have to outpace this. Otherwise, you're kind of falling behind financially through no fault of your own. And if you don't pay attention to that, you might not realize why it's difficult to make ends meet. In the kind of environment that you are suggesting here, where high rates kind of have these high deficits and they kind of flushes some money into the economy because some people are on the receiving end of some of those interest payments, it seems to me that M2 is going to continue to grow at a faster and faster pace. Is that just like an emotional response to what I'm seeing? I don't have the math behind it. It just seems like M2 never really slows down a lot. And then hearing about fiscal dominance, the way you're describing it, I guess I'm trying to figure out, how does M2 slow down? It seems like we're just on this path where M2 continues to grow faster.
So I do expect
to that.
Yeah, so I expect it on average to continue to grow pretty quickly. Now, in these past 18 months or so, we are growing pretty slowly. And even for a period of time, we're reducing, not really anymore, but
Yeah.
for a period of time, you're reducing. And that's because the Fed's QT, especially when they basically are affecting non-banks, that can reduce the money supply around the margins. And so there was some destruction of money. And also they did slow down the rate of bank loan creation. So we kind of flatlined in terms of U.S. aggregate bank loan creation. So you kind of either destroyed money or slowed down money with those levers, while the fiscal side was still adding to money. So I think temporarily, you can pretty much do anything temporarily. So had this 40% surge in money supply, and then since then they've been kind of trying to get it back down to the prior trend line. I think basically once we get to that point we talked about before, where the reverse repo facility runs out, and they're forced to go back to a period of kind of
Lyn,
gradual.
do you need to stop? Do you need a glass of water or anything?
No, I'm fine.
You okay? You're okay? Okay.
Yes.
Okay, good.
Once they go back to a period of gradual balance sheet expansion, I think that's when you have a period of kind of money supply reaccelerate back towards or slightly above its normal baseline trend. And I've also been looking at another metric, which is similar to M2, but basically I look at bank deposits plus currency in circulation plus money markets, which is a similar but slightly different metric. And you'll generally see that has not slowed down to the degree that M2 has. Because for all intents and purposes, people treat their money markets like cash, even though it can consist of T-bills and commercial papers and reverse repo and all these kind of wonky things. It's, for all intents and purposes, money. A T-bill is in many ways money, even though it's debt. Because even a dollar bill is a liability of the Fed. It's a type of debt in a sense. But basically, T-bills are money-like in a closer proximity than, say, stocks or long duration bonds are. And so things like money markets or the assets inside of money markets can be very money-like. And so in that sense, money supply is still growing pretty substantially. If you get a lot of T-bill issuance and a lot of money market usage, the overall kind of quote unquote real M2 is actually probably a little bit higher than what we see looking at the official M2 metric. And so while you can slow down it for a period of time, I do think it's likely to accelerate. And like you said, you generally want to keep up with broad money supply, or different metrics of broad money supply, or at the very least keep up on a per capita basis. So if money supply is growing by 7% a year, population is growing by 1% a year, you should at least be trying to keep up by 6% per year.
Got it. Never thought about it like that. Yeah. Yeah. Got it.
That way you're at least getting your share. Your share is not being diminished.
What a world. We have to keep track of how much new dollars come into existence just to not fall behind. So, and
I think that's the challenge. That's why inflationary policy works for policymakers, because the average person doesn't look at these things, and even if they could, it's hard to keep up with these things, right? It's hard if money supply is going up by 7% a year and population is growing. You're saying, okay, I want my wages and I want my asset price and stuff to not be diluted. It's a pretty high hurdle to meet that. And then when you go to developing countries, like I go to Egypt every year, they've got 20% money supply growth. So if you're not aggressively keeping your wages going up, or if you're a small business not aggressively raising your prices, or if you're a landlord not aggressively raising your rents, you're getting diluted on your income streams, your the property, the success of your investments. You're getting diluted by entities that are closer to the source of money creation.
I want to just switch briefly now just to your book, Broken Money. At the beginning of the book, you do this wonderful job of breaking down a credit-based system and a commodity-based system in those first few, I think it's like several chapters. And it was really eye-opening to me because it reminded me as a kid when I went to Croatia all the time in Europe, and my family was in a village there. And you just reading your pages made me realize what I had witnessed all those years. In this small village, they would help each other. So if it was time for a harvest, or if it was time to take up, the cattle to pasture, there was this kind of credit-based back and forth system that was operating in this small village. It was kind of like, we helped harvest the potatoes, they're likely going to help us harvest the wheat next, the next time we're harvesting the wheat. There was just this kind of implied, favors going back and forth in a credit-based system. It was almost unspoken. But one day my aunt took a big bull to sell to the market, which was a few villages down where they would have this market once a month. And I walked with her as a young kid. And it was this, huge bull she was selling. And because she was in the market outside her village, there wasn't this back and forth like credit-based system, because these people that were buying the bull from her were from like another village far away. So there they settled like as a spot price. And like I'll never forget, she sold the bull. I know this is a crazy story, Lyn, but this is what your book did to me.
I love this example because it's a tangible modern.
Yeah, like I'm like reading your pages. I'm like, holy shit! Like I experienced this in person. And then at the market, I'll never forget, she sold the bull. She got a small calf in exchange for the bull, and the rest she got as dinars. The currency that was in use at the time. It wasn't a great currency. They had to use it. They were locked into the dinars, but they settled as a spot price right there, because there was no way she was going to help these people from a few villages down, like harvest their potatoes. So I just thought that was just so amazing that the way your book kind of broke it down is completely accurate. Like I lived that. And it just kind of really drove home to me the difference between a credit-based system and like a commodity-based system for money. And can you maybe, for someone who hasn't heard that, because I know I try to articulate some of these things to people who are kind of born in Canada and share these concepts, could you just outline what a credit-based system and a commodity-based system? And before you do, I guess you made me also take the next step further. I'm like, holy crap. Like if you were to represent the favors that were going back and forth between those people in that village, my family and other families, and you were to represent those in little credit receipts, those would be what we call dollars today. And then if someone on the side was artificially creating more credit receipts, they would dilute the favors that were going back and forth if they put those credit receipts into the system, right? Because it can kind of work, a credit-based system, as long as no one's like, you're in the village and no one's diluting it unintentionally. But if someone was diluting those favors back and forth, the whole kind of system breaks, which is at a bigger scale. I know what we kind of have today. So you just really helped form some of these thoughts that I had experienced as a younger person in Croatia with my aunt there through your book. So thank you for that, Lyn.
So I appreciate that example. It's great to hear that because it's not, it's what happened in history, but
Yeah.
it's also what happened in pretty local modern times, just outside
Well,
of
that was
kind
the
of
1980s, what I described as
yeah.
the 1980s.
Yeah, it's pretty recent. We have a similar phenomenon here with the Amish. It's not that far from where I am. The Amish, they live a more rural lifestyle, kind of purposely without a lot of modern things, and they'll do, for example, a barn raising. They'll all get together and build someone's barn, and basically the cost for that is the next time when someone else needs a barn built, that guy's got to
Yes.
go and help him build a barn too. And you over time you build a little bit of everyone's barn, and it's this ongoing.
Evens
People keep
out.
track.
Yeah.
Yeah, and people know each other, and they keep track of who's holding their weight and who's not, and who can be given credit and who's not. And the reason I covered that in the book, so basically to go over the two types, when we think about, we want to solve the double coincidence of wants, right? Like if I, whether it's a hunter-gatherer economy, like, I have spears and you have furs, or it's a, kind of more rural kind of, like Amish or 1980s Croatia, whatever the case may be, like a more town-based, kind of smaller environment. If you want to solve the double coincidence of wants, you want to trade a bull for a calf or spears for furs. The challenge is that you have to find someone that specifically has excess of what you want. They're selling what you want, and you have to be selling something specifically that they want. And so there's more trades that fail. It's hard to find these like coincidental overlapping excesses and deficits. But there's really two ways to make that easier to do. One is you can defer through time, which is credit. Basically say, look, I mean, if you help me come build my barn, I won't give you anything now, but when you need a barn built next season, I'll chip in there too. And so it's that same kind, it's like that time-based deferment. Maybe you don't have a ton of excess apples that you can give the person the appropriate number of apples for his day of labor, but instead it's just, okay, that's Fred down the street, and Fred's going to help me build a barn next season or whenever I need a barn built. Or they helped, I sold apples here, but then they owe me a day of labor another time, right? So that's deferment through time, which is credit. And the other one is as you said, if you don't know the person, might never see them again, you instead settle on the spot, and that's where you generally need a more liquid unit of account, something that's good store of value. It's portable, it's divisible, it's recombinable, it has a lot of value density, and that's how we shells or cocoa and eventually gold and silver, basically those units that help kind of lubricate trade. And I just felt like, especially in the kind of the sound money like dialogue, not a lot of focus is put on that early credit environment. And even in modern just textbooks, they often say, okay, well, you would have barter, but then you have this instead. And they often leave out that a part of making barter work is that time deferment, that credit, because that's what makes barter actually kind of effective. And then the reason I covered that is, one is I wanted to bring that back into the discussion, to get away from just the strict idea of the only thing is money is commodities. There are other types of money. But then I also wanted to be critical of some of the people that are, I think, overly optimistic on a credit-based system, because they act as though, in many cases, some of the people I would critique is they basically say you don't even need commodity money at all. You can just defer these claims around, and it's like, well, sure, until your family member has to go 2 towns over, and then your system breaks down. There's a lot has to be going right for that little credit system to work, and there's a countless reasons why it wouldn't. Basically, travel or other reasons why you just can't use credit all the time. You eventually need kind of final settlement, savings, portability from community of value. And so I cover that in the book to show that there are really kind of two roots of what money is, and they're both based on the two primary ways of solving the double coincidence of wants.
I appreciate it. I think you do a great job. I think it helps. The way you break it down in the book helps you recognize the current problems in today's world, because I don't think you can appreciate what some of the solutions might be without fully understanding where some of the gaps in today's system might exist. And the way you broke that down in the first few chapters really, to me, does a good job of helping understand where the current system is broken. And then you can come to appreciate what might be required to solve that. And I think when you're born in a system where it's just credit-based money from birth, if you're born in Canada or the US and it kind of worked kind of well, you don't have the opposite to compare it against. So you can't really articulate or understand what might be better or could be better or how it could be better. So I think you do a great job in the book of just kind of breaking that out really nicely. I just wanted your thoughts on this. On page 269 of your book, you have this passage from, I don't know how many years ago in Greece, where they were just talking about a debt jubilee and the requirement for a debt jubilee. Actually, in that chapter, you talk about debt jubilees with a few different examples, and just how there's ultimately, throughout history, there is some record of this being necessary, that eventually debts need to be forgiven. Otherwise, the weight of these debts just builds up too big and the kind of the system breaks down. We're in a current system that doesn't seem to have a debt jubilee unless you maybe inflate away the debts. I guess, where do you think we're headed? Like, are we headed towards some type of forced debt jubilee on the current path we're in? And how would that look?
So I think that's where the developed world's headed, and I think it's probably through inflation. Basically, you can have a debt jubilee either nominally or through currency debasement. And the way the current system is structured, it's very hard to do it nominally because you basically bankrupt the whole banking system. And so generally, it's like, how did we get out of the 1940s? Like war debts, for example, the answer was basically you inflated them away, right? So on one hand, you got back to a period of pretty strong real growth and some degree of austerity, but it's not like they paid down that debt in real terms. Instead, there was a significant part of inflation that was involved. Basically, if you loan money to an entity that is over leveraged and like unable to pay it back realistically, you're going to lose purchasing power, and it just that at that point is determined how. If it's a private sector lender that can't print their own money, they're probably going to default in some way, and you're going to, either have to turn your debt into equity or otherwise get restructured and take a haircut on your value. Or if it's a sovereign entity that can print its own money, then you're still probably going to lose purchasing power. But instead of a default or restructuring, you're probably just going to get the same number of units back as you're expecting, but those units buy 2/3 of what they could buy before, or half of what they could buy before, depending on the duration of the debt we're talking about here. And so, I would consider what we saw in the 1940s, the 30s and 40s, a type of debt jubilee. Basically, any sort of gold peg break is a type of debt jubilee in some way. Anytime there's a big expansion in the money supply compared to the existing debt levels is basically a type of debt jubilee. The default on the Bretton Woods system and the inflation that came in the 1970s is also a type of debt jubilee. And I think we're probably getting close to something now. And of course, it can be destructive when it happens on such a big scale. When you have a country like the United States with 330 million people, that also then their monetary policy affects the rest of the world too. When an entity like that goes through a debt jubilee, that's different than like your local kingdom, the king proclaiming that all consumer debts past 7 years old are null and void now, right? That's a local, more manageable type of debt jubilee compared to these other ones we're having now. And going back to your prior point, the interesting thing about those kind of local credit-based monies is that they're actually it's hard money in a way, because no one is diluting the favors, right? It's like everybody, because their memories are involved.
Some people might try to, but you're right. There's units of work that you're kind of remembered in your head on what's owed back to you. Yeah.
Yeah. Occasionally there's a default, but sure. But aside, defaults happen in hard money environments. Basically, the money itself's not being aggressively diluted. And like you said, imagine if someone could kind of slip more favors in there.
Yeah.
And basically have more favors owed to them that for work they never did. Right. That'd be cheating. And yet that's exactly what we see in the current system, which is that as you get kind of monetized fiscal spending, or you get kind of persistent periods of negative real rates, there's people on the winning side of that, and there's people on the losing side of that. And basically the people that are on the winning side of that, especially if they're near the source of money creation itself, rather than just kind of outside taking advantage of it, but if they're in some way responsible for it, they're kind of gradually rug pulling and diluting everyone else and trying to suck some value out of that system. And that's the big challenge in debt jubilees, is that of course everyone's going to try to get a bigger share than they're owed, right? Everyone wants a piece that's, oversized. And if you're in a position of power, you can use that to your advantage. And so it can be very destructive when these currency problems happen.
I love the way in the book you break down kind of like the older, money systems that have been used. Then you talk about the current system in great depth, and your explanations of the Federal Reserve were really helpful to me. I kind of read a lot of different books on the Federal Reserve, but there was just a whole bunch of points in there that you do, to me, a great job of making it really self-evident on what the Federal Reserve is doing and their kind of role in the current system. And then you kind of get into, new forms of money, and specifically Bitcoin. When you introduce Bitcoin in the book, did anything new come to mind that you began to appreciate Bitcoin in a different light? Or was it just the framework you discuss it, like an honest ledger? Or, for someone who hasn't given money as much thought as you have, how would you begin to articulate Bitcoin to them? What framework do you like to start with when you're trying to explain money and Bitcoin?
So I think, basically before the book came together, I was resistant writing a book because it can be very time consuming. It's just not something that is usually a high ROI thing to be doing. But once a couple key themes came together, I couldn't stop thinking about it. And so now it's time to write the book. It's time to put this together. And there were a couple of those in particular. One was that I wanted to talk about, we just talked about the commodity versus credit money and how to kind of reconcile those by realizing that they're all types of ledgers. And it just depends on what ledger you're using. Is it your local, like, memory-based community ledger?
Village ledger, yeah.
Is it your informal village, your neighbor and village ledger? Are you using a commodity as a ledger? Basically, there's a certain rate that you can make new gold coins. It's hard to cheat the system, and if you have a share of gold in the community, you're kind of holding your spot on a ledger in a way of speaking. Or is it like a large centralized administrative ledger? Is it like the temples of Babylon or on their clay tablets, or is it a central bank, right? So that's one thing I wanted to kind of explore, those two concepts, and show that they're really kind of two sides of the same coin in a way. The other one that I want to emphasize was the role of the telegraph in changing our money system more than we think, which is the fact that prior to that, transactions and settlements could move at roughly the same speed, right? So everything, all information still moved at the speed of matter for the most part. Whereas with the telegraph, we could now send information around globally, roughly at the speed of light, in pretty high volumes, and yet any sort of physical settlement of something like gold was now kind of just it's still material. It's still very slow, especially when you consider verification and the auditing of the gold itself. And so that kind of opened up the need for a lot of arbitrage. There has to be some sort of abstraction, some sort of ledger, some sort of credit that's kind of facilitating that gap that we're relying on. By the time we get a transaction that we know is, this piece of paper I'm given or this kind of bank deposit I'm given is in theory redeemable for gold, but it's like if I don't plan on doing it anytime soon, I'm kind of relying on this big chain of credit. And so I wanted to kind of focus on how that expanding speed gap opened up so much arbitrage for banks and central banks and governments that is more than we think. And then the third one was the third theme was basically how the kind of the end state of that is how we have 160 different currency bubbles, right? So Egypt has its own little, it's like a casino chip, right? Yeah. Like if you have an Egyptian pound, it's really a casino chip in the sense that anywhere outside of Egypt, like what do you do with this thing? It's not really money anymore. It's only money in its casino, in the kind of enforced monopoly that it has. But then the same thing's true for Norway. Norway is a wealthy country, but their currency is still basically useless outside of Norway. If I have Norwegian currency in New Jersey, United States, like it's actually kind of hard to find a way to get this off my hand. It's not a very saleable good. I'm either going to have trouble getting it to someone to take it at all, or it's going to be at a significant discount because it's too far outside of its own jurisdiction. And they're able to maintain these monopolies in large part because of that that speed mismatch. So basically, the only two ways to get money in or out of a country historically were ports of entry. So bring your cash or gold through an airport, which is obviously highly restricted, usually like $10,000 or less, and then or bank wires. Including fintech on top of bank wires, but ultimately it's banks sending money in or out of the country, which of course only happens at the pleasure of the regulators. Basically, they can control what money comes in and out, what units someone can get. If I am a Egyptian and I do work for a forwarder and they want to pay me in dollars, it's kind of up to my banking system and my government whether that hits my account in dollars or
disaster.
Egyptian pounds.
Yeah.
And so, like I know a videographer in Egypt, he does work for foreign buyers. And he charges in dollars, like he sets his prices in dollars. And they, if they have to film something, like a business I work with wanted to film something with me while I'm in Egypt, so they hired him. He charges in dollars. It hits his bank account in Egyptian pounds, and then he's got to figure out what he's going to do with his pounds now. He's not going to just hold Egyptian pounds because they're, inflating away. And what's interesting is that for the first time, Bitcoin kind of solves these last two problems, which is it's the first credible way to send value long distances without relying on credit. All you're relying on is the ongoing functioning of a decentralized network. So all you're relying on is there not being a 51% attack to reverse your transaction, which is different than credit. So you're sending a largely irreversible bearer asset to someone at roughly the speed of light, especially if you're using something like the Lightning Network. But even if you're using the base layer, it's half an hour for a reasonably settled transaction. And also you have infinite value density. So for example, unlike an airport, with an airport with cash or gold, with Bitcoin, you could memorize 12 words and bring $1 billion through an airport if you had it, right? There's just infinite value density that can go in or out of countries.
It's so beautiful.
Yeah. It breaks that whole thing wide open. And then secondly, if I want to pay a videographer in Egypt, he can send me a QR code or a string of numbers, and I can pay him in whatever he wants. It could be Bitcoin, it could be dollar stable coins, whatever he wants.
With reasonable privacy. Yeah.
Yeah, with reasonable privacy, and it depends, and there's ways to improve that over time. But, he can get some degree of just direct to him that goes around his local banking system. The same thing is true, like if there's a Norwegian graphic designer and she charges whatever she wants. She's okay, I want stable coins, I want Bitcoins. And instead of going through like their local official exchange rate, it can go at the real kind of the street exchange rate. Like it can get directly to her, and then she can either, in some cases, depending on where she is, just spend that directly. She could spend with Bitcoin or spend with stable coins. Or if she does convert to the local currency, she's now basically converting on the street rate, which is better for her to get back into the local currency. And so these kind of 160 different currency bubbles every one of them has their gates down now. They're all starting to get cracked open. And of course, this takes time because only in the past 5 years has any of this been liquid, right? So stable coins were tiny until this last cycle. Bitcoin was fairly small until the last like 2 cycles. And until it gets kind of bigger, less volatile, just more liquid overall, more awareness, more comfort with how it works, it's kind of limited at the current time. But the more Bitcoin communities pop up, the more people use stable coins, whatever's working for them, whatever the market forces kind of end up wanting. There's pros and cons to both, obviously. That just starts cracking this like artificial framework we've had for the past, century and a half, really. And I don't think that the market understands that how big that can be yet. Like it can change macro, it can change money. It has huge implications. As long as just a couple things are true, as long as the Bitcoin network remains decentralized, secure, and as long as its overall adoption and liquidity keeps improving because it is solving a problem. And if that happens, then that I think just increasingly chips away at these currency bubbles we have.
Maybe then the right way to look at history is that gold and silver acted as hard money on and off, but for large periods of time on as hard money, throughout history. And then technology changed, as you're saying, with the telegraph, where the speed, and you mentioned this several times, the speed of transmission versus settlement is kind of been disjointed. And the money didn't match that. And it opened up this arbitrage opportunity for the banking system for, let's say, the last 100 or, even more years. But now that gap might be closing again because of the emergence of Bitcoin. And it introduces a rather interesting inflection point in humanity to me, because it really can change economics and the way people think about saving, the way people think about investing their money. Because if you do have a hard money again that really does serve the world in a functional way, then I'm only going to give up that money or invest in projects or businesses that really have a good return. Whereas in the past, in the last, 10, 20, 30 years, credit's been cheap, interest rates have been low. So you get a lot of kind of disjointedness in the economy with a lot of malinvestment and things that shouldn't be monetized. And we could be looking at a really interesting future if this evolves the way that we think it will. I don't know if that's the next, short few years or several decades, but it does present a lot of, to me, exciting opportunities for everyone. So I get all crazy excited about it, Lyn. So I love the way you...
Yeah, I think it's fascinating how it solves kind of multiple problems simultaneously. So the one that it solves, I think, most universally is the store value problem, because wherever you go in the world, people are monetizing other things because they don't want to hold just money. Especially in this kind of last 15 years of zero interest rate policy. So they say, okay, well, I want to buy this really expensive real estate instead. I want to buy this really expensive equities instead. And of course, there are places for all of those. I mean, I have real estate and I have equities. But it's like in Egypt, for example, people will buy another home and it's just sitting there empty because they're like, well, I'm not going to invest in the local stock exchange because it's not as reliable as the US market. And I'm not going to hold cash or bonds. So I guess it's real estate. It's either real estate, gold coins, or physical cash dollars they got in the gray market. That's kind of that's their options. And so and in the United States, we just shovel money into our 401ks and just monetize the S&P 500. And that has some distortion effects on business formation and things like that. And in some countries, it's a lot of you get real estate bubbles because of that. People say, well, I want to hold something that's outside of this jurisdiction, or I want to hold that, and you kind of drive up certain prices beyond what they should be in a healthier environment. And those are just kind of they distort things. And then the other problem that Bitcoin solves for some people that those of us in the West generally are less aware of is the payments issue. So, for example, there's something like 40 currencies in Africa. There's like 30 currencies in Latin America. And it can be non-trivial, for example, to send money from Nigeria to Kenya, right? Or the cost to do so end up being just non-trivial. And that should be, it's 2023, that should be trivial. And the interesting thing about things like Bitcoin is that it just can bridge that gap. So apps can work with each other as long as they have internet connection and just have this kind of shared open source way of communicating with each other in a way that's not really working for a lot of people right now. So, those of us in the United States or Canada or Europe, we generally don't have that many payment frictions on a regular basis. Sometimes if we send an international wire, we'll be reminded how antiquated some of this is. But other than that, we generally don't go around every day thinking, if only I had better payments. Only around the margins do we see it. But in a lot of countries, it's non-trivial. And then especially when you do think of this global scale, when you think of global remittances, when you think of apps and money systems being able to communicate with each other across borders, I think all of that can get way better. And I think a really good analogy is email. So every webmail client can talk to other webmail clients because they're using the same open source underlying protocols. They don't have to make Yahoo and Gmail don't have to get together and make sure that their systems are compatible. They just have to make sure that their systems are compatible with the underlying open source. And so when you have open source, Bitcoin base layer, Lightning, whatever other layers could exist, any entity that starts interfacing with those systems now starts interfacing with every other kind of environment, money ecosystem in the world that is also tied into that system. And so, for example, Cash App has got a very large set of users, and by incorporating into the Bitcoin and Lightning Network, they start connecting to other ecosystems around the world without even necessarily knowing it. Now there still can be frictions on that in terms of like KYC, AML, and kind of these artificial restrictions that start go on top of that. But the point is, I think that basically having these open source layers that can connect different monetary ecosystems together and bypass their artificial kind of firewalls, I think changes a lot, and mostly for the better.
Yeah, and you might not know this. There's a company up here called Bull Bitcoin based out of Canada, where for $1,000 or less, you can do non KYC Bitcoin purchases by just going to one of the Canada Post Office. You walk in with a QR code, and if you have $500 in cash, you can put it, give them the QR code, they scan it, you hand over the $500. I think the fee is like $3. And it'll fund your account that you can then go buy Bitcoin in a non KYC fashion. Like, to me, that's just, first of all, I'm hesitating if I even should have shared that because I don't want the government to shut that down. But that exists, and I think it's really kind of something that Bitcoin is bringing to the market that I can't even believe exists right now. Like, it should exist, and it's a really great thing that does exist. And in Canada also, we're right next to the US, and Canada's, considered a developed nation, part of the G7. But when Bitcoin recently hit half of its recent all-time high, so when I think it hit about $35,000 US in the last week or 2 weeks or so, it was a big realization for people here who had been in Bitcoin for a little bit, because when they saw their Canadian dollar balance of Bitcoin at half of the all-time high, they just doubled it in their minds and thought, oh, if Bitcoin never goes back to the all-time high in US dollars, I'm actually well beyond that in Canadian dollars. And that was the first realization to many people, like, wow, what's going on with the Canadian dollar? And it started a whole discussion in the office here, like, hey, what the heck is happening with the Canadian dollar? And this isn't some currency that's, it's not the American dollar, but the Canadian dollar is considered a fairly decent store of value. So I really appreciate that Bitcoin's kind of opening up those discussions for people as well. I want to honor your time, but I want to get one more question on time management in there. Is that okay? Do we have a couple more minutes?
Sure.
Yeah. Okay.
Happy to.
Okay. Thank you. Anthony on our team made me ask you this question. So can you please ask Lyn, how does she get so much done? Do you have like a time management when you're researching for your, the newsletters that you're putting out or for the book? Do you have like a time management strategy just for the day or the week that you're consciously kind of planning around that you could share with us? Or is it just, an ad hoc system that when you get time, you work? Or are you very kind of honed in on how you're spending your time every day?
So for me, it's very ad hoc and very simple. So there's nothing complex about it, but there are a couple tangible things that I do that might have not work for other people, but they're just work for me. So it's basically every day I have a very short list of things I want to get done. And if there's 5 things and I hit 4 of them, and I do that every day for 365 days a year, or 300 plus working days a year, that adds up to 1,000 things I did that year, right? And it could be simple, like, okay, clear out the email backlog, or write the first draft of this article or this premium report, or write the draft of this chapter, right? So it's just like I have you could put it on on a Post-it note, just like do these 5 things, and if I hit 4 of them, I'm like, okay, it was a pretty good day. So just micro lists. The other one is that with my writing content, at any given time, I'm working on them simultaneously. So rather than just working on one and getting that done and then going on to the next one, I usually have a couple things that are all like in the oven to different degrees of readiness. And the reason for that is so that I never run into writer's block or get stuck. There are sometimes that there's a challenging article, or maybe it's a boring article, or maybe there's something I have to research and I just don't feel like it right now. And it's not progressing. It's the quality or the time it's taking is just not up to what I'm liking. I'll just kind of leave that aside and just say, well, I'm going to leave this draft here the next month, and I'll be working on something else. And then one day something will click, and I'll go back and be able to finish that article more quickly. Something re-sparked my interest in it, or I just kind of had a shower thought and maybe I had a formatting problem, and I went back and solved that. And so for one example is my What is Money article. It was one of the longest articles I've ever written, and it played a role in eventually the formation of the book, Broken Money. And that article probably took 3 months to write, not because I was actually working on it for 3 months, but because I started working on it It was just so long, and I was trying to think of how to format this, and I just kind of it started to feel like a grind. So I just kind of put it aside for like a month and just went back to other stuff like a newsletter or, kind of other stuff I'm working on or clear out my other to-do lists. And then eventually just the formatting clicked for me and I came back and finished it more quickly. And so that kind of parallel work I think at least for me personally, a big part of how I churn so much out. And one point of validation is that there's an author named Brandon Sanderson. He writes like fiction, like fantasy and sometimes sci-fi. And I mean, like his books sell extremely well. Like he's one of the best-selling authors in those genres. Like up there with like J.R. Martin kind of level, even though he's not really had these like cinematic works yet, but he's like his numbers are like that insane. But he's actually even more known for the sheer number of books this guy puts out. There's like some authors actually J.R.
They're
Martin, like
prolific.
yeah, everybody's waiting for like the next J.R. Martin book forever. There's this other author, Patrick Rothfuss, and he's got this like two parts of a trilogy and people are like dying waiting for the third part and it's not happening. Whereas this Brandon Sanderson is an absolute machine in terms of prolificness. The sheer number of like long books, like 1,000-page books combined with like 300-page books combined with, and if you look at his like website, he's got this like status bar. And he'd be like, okay, this book's 75% done. This other book is 40% done. This other book is 80% done. And so he seems to be using a similar strategy of parallel book creation,
Interesting. Got it.
which is similar to how I do articles or book chapters and things like that. So there does seem to be some validity to that approach, at least for some people.
Well, I would say you are prolific, Lyn. So thank you for everything you're doing. Thank you for the impact that you're having. I think I've heard Jeff Booth say this before, like just, one person can really have an impact on a lot of people. To me, you're one of those people. I'm a happy subscriber to your premium newsletter. I love the content that you put out, the book that you're putting out. I've listened to so many of your podcasts and I always learn something from listening to you. So just thank you, because the impact that you're having on, me, then I go and talk to other people, like you're probably having, there's orders of effect to this, and you're maybe having an even larger impact on all of us than you perhaps even know. So thank you for everything you're doing. So with that, yeah, no problem. Can you talk to us just, about Ego Death, what you're doing with Ego Death Capital? And I think everyone at this point probably knows the book, but if you don't, it's called Broken Money on Amazon. You can get Lyn's book. But yeah, can you talk about Ego Death Capital and your involvement there?
Sure. Yeah. So, but for a while, my primary work was research. So lynalden.com and as well as this book. But I've been working with Jeff Booth and others on venture opportunities in the Bitcoin space. And, it touches on other areas as well, like, stable value, for example. But it's just kind of realizing that because of some of the things we talked about, we expect there to be a lot of kind of businesses, to be done, work to be done in the years ahead as liquidity gets better and as the UX gets better. And so we're deploying capital in that space. So it kind of brings me back to my almost like I used to be an engineer, and even though I'm not an engineer anymore, I like the idea of contributing in some small way to build something, not just analyze things and not just trade things around, but help bring into existence something new, right? Whether it's capital or experience or help marketing for them, whatever the case may be, or if it's engineering, as it used to be, that's something I've been finding a lot of enjoyment in.
Cool. And then your website to get on, because just your free newsletter is so valuable. So if you're listening to this and this is the kind of information that you're interested in, get on Lyn's free newsletter. And then the premium newsletter, you can subscribe to that off the website as well. Can you just remind me the URL for that website? Is it just lynalden.com or is it Lyn Alden Contact?
It's lynalden.com. And okay. My Twitter is at Lyn Alden Contact.
Okay, Twitter, Lyn Alden Contact. Awesome, Lyn. I mean, thank you for this. Really, really appreciate it. And keep doing what you're doing. Thank you.
Thank you.
Hey, thanks for tuning in. You can find every new episode of the Your Life, Your Terms show on all the major streaming platforms. So Spotify, iTunes, Google Play. And if you'd like to get free copies of some of the books that we've put together, like these right here, or some of the reports that we've put together, like these right here, you can find all of those at www.rockstarinnercircle.com. That's www.rockstarinnercircle.com. That's it for now. Until next time, your life, your terms.